$85 billion. That's how much money investors have poured into SCHD. It's one of the most popular dividend ETFs ever created. But sitting right next to it on Schwab's shelf is an almost identical fund with just $2.2 billion. Same parent company, same dividend screening methodology, same quality filters, a 39-to-1 gap in assets, and almost nobody's talking about it. That's not a small difference. That's the difference between a stadium full of fans and an empty parking lot. And here's what makes it strange. Over the last 12 months, the smaller fund didn't just keep up with SCHD, it crushed it by more than double, 37% versus 17.98. So either millions of investors are right to ignore this fund, or they're making a massive blind spot mistake with their portfolio diversification. And by the end of this breakdown, you'll know exactly which one it is, and whether this fund deserves a spot in your long-term investing strategy. Quick disclaimer: I'm not a financial advisor, and this isn't financial advice. Always do your own research before making any investment decisions. Here's something most American investors don't realize. The US stock market makes up less than 50% of global market capitalization. Less than half. But the average US investor puts 75% of their money into domestic stocks. Think about that for a second. You're concentrating 3/4 of your wealth into less than half the opportunity set. Economists call this home bias. And for years it didn't matter, because American stocks kept winning. The S&P 500 dominated. Big tech dominated. And anyone who diversified internationally felt like they were leaving returns on the table. But 2026 is telling a different story. The S&P 500 is down 0.14% year-to-date. Meanwhile, international stocks, measured by VIXUS, are up 9.23%. That's not a small difference. That's a complete reversal of the trend everyone got comfortable with. And if you're building a dividend portfolio, the international numbers get even more interesting. 84% of international stocks pay dividends. In the US, just 66%. International dividend yields average between 3.5 and 6%. American dividend yields, 2 to 3%. The rest of the world is paying more income on more of its stocks, and right now it's also delivering better total returns. But most dividend investors never look outside the US because they don't know where to look. And that brings us to SCHY. SCHY is the Schwab International Dividend Equity ETF. It launched in April 2021, which means it's turning 5 years old next month. Here's why it matters. SCHY was built with the exact same DNA as SCHD. Both funds require companies to have at least 10 consecutive years of dividend payments. Both screen for cash flow quality. Both filter for profitability. Both use fundamental weighting instead of just buying the biggest companies. The methodology is nearly identical. The difference? SCHD buys American companies. SCHY buys everything else. 132 stocks across more than 25 countries. And here's the critical detail. There is zero overlap between the two funds. Not a single shared holding. That means if you own both, you're not doubling up on anything. You're genuinely spreading your dividend income across the entire developed world. Now, let's talk about what SCHY actually holds, because this isn't some random basket of obscure foreign stocks. The top positions include BHP Group out of Australia, one of the world's largest mining companies, Roche from Switzerland, a pharmaceutical giant, GSK from the United Kingdom, Vinci from France, which builds and operates infrastructure across Europe, Ono Pharmaceutical from Japan. These are serious companies, the kind of businesses that have been paying dividends for decades. The sector mix is worth noting too. Financials make up 15.7%. Consumer defensive, think food companies, household goods, the stuff people buy no matter what the economy does, accounts for 14.6%. Communication services at 13.8%. Healthcare at 12.3%. Notice anything? These aren't speculative growth sectors. These are the parts of the economy that keep paying dividends through recessions, through market panics, through everything. The country breakdown tells an interesting story too. The UK makes up over 20% of the fund, Australia about 12%, France 12%, Switzerland 10%, Japan 7%. You're essentially getting a curated collection of the world's best dividend payers, weighted toward the most stable economies on the planet. And the cost? This is where it gets really compelling. SCHY originally charged 0.14%, already cheap. But Schwab recently cut the expense ratio to 0.08%. That's $8 a year on $10,000 invested. For context, SCHD charges 0.06%, so the international version costs you just $2 extra per $10,000. That's practically nothing for access to 25+ countries. Now, performance. And this is where SCHY starts turning heads. Over the last 12 months, SCHY returned 37%, SCHD 17.98%. The little brother more than doubled Big Brother's return. Let that sink in for a moment. The fund with $2.2 billion in assets outperformed the fund with $85 billion. SCHY also beat its own benchmark by 400 basis points over the trailing 12 months. Which means it's not just riding a wave. The fund's selection process is actively adding value on top of the broader international rally. Over 3 years, SCHY has compounded at 14.23% annually. Over 5 years, and this includes a brutal 2022, the KGR sits at 6.08%. The current yield? Between 3.25 and 3.52%. Roughly in line with SCHD's 3.32%. So you're not sacrificing income to go international. But here's the thing, you can't just look at SCHY in isolation. You need to see how it stacks up against the competition. And there are really only 2 serious alternatives for international dividend investors. So let me walk you through them, one at a time, because the differences are massive. First up, VUMI, the Vanguard International High Dividend Yield ETF. On the surface, it looks like a strong competitor. It yields about 3.5%. It holds a whopping 1,623 stocks. And over 5 years, its KGR is 14.39%, actually higher than SCHY's. So why not just buy VYMI? 2 reasons. First, the expense ratio. VYMI charges 0.17%. That's more than double what SCHY costs. On a $100,000 portfolio over 20 years, that difference compounds into real money. But here's the bigger issue. Risk. SCHY's maximum drawdown since inception was negative 24%. VYMI's? Negative 40%. That's almost twice the pain during the worst moments. And when you adjust for risk using the Sharpe ratio, which measures how much return you're getting per unit of risk, SCHY scores 3.52 versus VYMI's 3.08. Better returns per unit of risk. Lower fees, smaller drawdowns. SCHY wins that matchup. Now, the second competitor, IDV, the iShares International Select Dividend ETF. And honestly, this one isn't even close. IDV's headline yield looks incredible, somewhere between 4.43 and 5.3%, the highest of the bunch. But look under the hood. IDV charges 0.50% in fees. That's 6.25 times more than SCHY. And the long-term returns are rough. Since IDV launched in 2007, its annualized return is just 3.56%, not per month, per year. Over nearly 2 decades. Factor in inflation, and you've barely grown your purchasing power. A high yield means nothing if the total return is this poor. IDV is essentially a yield trap, paying you income with one hand while your principal stagnates with the other. So after comparing all 3, SCHY gives you the lowest fees, the best risk-adjusted returns, and a methodology backed by the same system that built one of the most successful dividend ETFs in history. VYMI holds too much risk. IDV charges too much for too little growth. And SCHY sits right in the sweet spot. But here's where it gets really interesting. And this is the part most people miss. SCHY isn't meant to replace SCHD, it's meant to complete it. Think about it. SCHD gives you 101 American dividend stocks. SCHY gives you 132 international dividend stocks. Zero overlap, same quality standards. Together, that's 233 of the world's best dividend payers across more than 25 countries. For a blended expense ratio of basically nothing. Let's say Harry has $100,000 to invest. He could put all of it into SCHD, safe choice, proven track record. But what if he splits it 70-30? 70,000 in SCHD and 30,000 in SCHY. Based on historical data, the all-SCHD portfolio might edge ahead by about $13,000 after 10 years. That sounds like a lot, until you realize it's roughly a 5% difference. And in exchange for that 5%, he could potentially get diversification across 25 countries. Protection against US dollar weakness. Exposure to dividend payers in Europe, Asia, and Australia that SCHD can't touch. Think of that $13,000 as an insurance premium for not having your entire retirement dependent on one country's stock market. Now let's run another scenario. Harry decides to put $500 a month into SCHY for the next 20 years. Just SCHY alone. Based on its historical returns and current yield of roughly 3.3%. His portfolio could potentially grow to around $294,510. And here's the beautiful part. At that point, SCHY could be paying him approximately $834 per month in dividends. That's more than his $500 monthly contribution. The fund would potentially be paying him more than he's putting in. That's the compounding crossover point, where your money starts working harder than you do. Or take the simplest scenario. Harry puts $50,000 into SCHY today and doesn't add another dime. Just reinvest the dividends for 10 years. Based on historical performance, that $50,000 could potentially grow to around $107,946, generating roughly $306 per month in dividend income from a single investment. No extra contributions. That's the power of a quality dividend fund doing what it was built to do, compounding quietly in the background while you go about your life. Now, I'd be lying if I said there weren't risks. There are, and you need to know them. First, currency risk. SCHY holds stocks priced in pounds, euros, yen, Swiss francs, and Australian dollars. When the US dollar strengthens, those foreign currencies translate back into fewer dollars, which drags on your returns. This works both ways, of course. A weakening dollar helps, but it adds a layer of volatility that domestic funds don't have. Second, dividend timing. International companies don't follow the same neat quarterly schedule that American companies do. Many pay semi-annually, some pay annually. SCHY's dividend payments can be lumpy and uneven from quarter to quarter. If you're living off the income, that requires a little more planning. And third, the historical TAGR gap. SCHY's 5-year KIGR of 6.08% is significantly lower than SCHD's 11.83% over the same period. The last 5 years included a stretch where international stocks broadly underperformed the US, and that dragged SCHY's long-term numbers down. That trend has reversed sharply in 2026, but there's no guarantee it continues. International could lead for 5 years. Or the US could reclaim the throne next quarter. Nobody knows. And that uncertainty is actually the reason you diversify in the first place. So who is SCHY actually for? It's for the investor who already owns SCHD and realizes they have 100% of their dividend income tied to a single country. It's for someone who looks at a 39-to-1 asset gap and sees opportunity instead of a warning. And it's for anyone who understands that diversification doesn't mean owning more US funds, it means owning the whole world. SCHD built the blueprint. SCHY took that blueprint global. $2.2 billion in assets versus $85 billion, a 39-to-1 gap, and right now, almost nobody is paying attention. That won't last forever. If you want to see the exact amount